Welcome back, it's JWalter here. Consumer prices in the United States rose 8.5% in March, and this is the highest levels we've seen since 1981. So that is the topic of today's video, the Consumer Price Index, or the CPI numbers that were actually just released this morning. So on CNBC, they say consumer prices rose 8.5% in March, slightly hotter than expected, and the highest since 1981. Again, this was just published this morning, which is April 12th. And to give you a very brief background, the CPI, or the Consumer Price Index, is the prices that consumers pay for everyday items. In any case, according to this report, the Consumer Price Index jumped 8.5% from 1 year ago on an unadjusted basis, above the already elevated Dow Jones estimate of 8.4%. So the street was estimating for an 8.4% increase, and the index actually jumped 8.5%. And a key metric that the Federal Reserve and a lot of economists track is what's called the core CPI. That's excluding food and energy costs. That increased 6.5% on a 12-month basis, in line with expectations. However, there were signs that core inflation appeared to be ebbing, as it rose just 0.3% for the month, less than the 0.5% estimate. That in turn sparked some hope that inflation overall was easing and that March might represent the peak. So here's the actual report on the Bureau of Labor Statistics website, and here's the actual data regarding core CPI. Again, core CPI is all items less food and energy. As you can see here, March 2022, which is the latest data that just got released this morning, that increased by 0.3% compared to the prior month. So in January, it was at 0.6%, and that decreased slightly in February and also decreased again in March. So it's starting to see a slight decrease over the past few months, which is a positive sign with our economy. And the markets reacted positively to this report here because stocks rose and also government bond yields declined as well. So here's the latest regarding the yield on the 10-year US Treasury note. If you follow my YouTube channel, you know that the yield on the 10-year US Treasury note is tied more directly to mortgage rates than anything else really. So right now that yield is 2.722%. At the start of the day, as at the end of yesterday, it was at 2.78%. So the Treasury yield has been declining thanks to this CPI report here. Andrew Hunter, who is a senior U.S. economist at Capital Economics, stated the following: the big news in the March report, the March CPI report, was that the core price pressures finally appear to be moderating, as we saw there with core CPI decreasing over the past few months. He also thinks the March increase will mark the peak for inflation. We'll have to see about that, and also I'll definitely keep you posted regarding that as well. Meanwhile, the Federal Reserve Governor Lael Brainard said this slowing increase in the core CPI is a welcome development. I'll be looking to see whether we continue to see moderation in the months ahead. But core inflation right now is the hottest it's been since August of 1982. So a lot of you are probably wondering, how is the CPI index and also inflation in general, how does that affect our general economy and also consumers as well? And here's a really good summary regarding that. So real earnings, which is our real wage earnings by people, despite rising 5.6% from 1 year ago, are not keeping pace with the cost of living. Real average hourly earnings posted a seasonally adjusted 0.8% decline for the month because inflation is running rampant. And of course, to combat inflation, the Fed is raising the federal funds rate and is expected to continue doing so through the remainder of the year and into 2023. And right now, the street is estimating for the Fed to increase the federal funds rate by 50 basis points by a probability percentage of 87.1%, and this is according to investing.com. And meanwhile, because the yield on the 10-year US Treasury note has been decreasing, the average 30-year fixed-rate mortgage, according to Mortgage News Daily, actually decreased to 5.12%. And this is a decrease from yesterday's 5.25% average, but still rates are almost 2% higher than they were 1 year ago. It goes on to say this report here, the last time prices were this high, the Fed raised its benchmark rate, which is the federal funds rate, to nearly 20%, pulling the economy into a recession that finally defeated inflation. Economists generally do not expect a recession this time around. We'll have to see about that, though many on Wall Street are raising the probability of a downturn. And here's the actual report from the Bureau of Labor Statistics. This is 37 pages long, but I'm going to give you a brief summary regarding this report so you don't have to read this entire report. So this is, again, was released today at 8:30 a.m. Eastern Standard Time. Of course, this is a Consumer Price Index, or the CPI, for March 2022. It increased 1.2% in March compared to February. after rising 0.8% in February. So overall, the consumer price index increased from February. Over the last 12 months, the all items index increased 8.5% before a seasonal adjustment. Increases in the indexes for gasoline, shelter, and food were the largest contributors to the seasonally adjusted all items increase. The gasoline index rose 18.3% in March and accounted for over half of the all items monthly increase. As you guys probably all know, gasoline is at insane prices right now, and we're seeing that here in the data here. In contrast, the index for used cars and trucks fell 3.8% over the month. This is interesting to see this because everyone knows that new and used cars have been skyrocketing really ever since this pandemic started. So it's interesting to see how the index here has recently fallen for that. I'm going to be sharing some stats regarding that in here in just a little bit. The all items index rose 8.5% over the last 12 months, the largest 12-month increase since the period ending December 1981. The all items less food and energy index, that's the core CPI, rose 6.5%, the largest 12-month change since the period ending August 1982. The energy index rose 32% over the last year, and the food index increased 8.8% compared to 12 months ago. All right, so here's a table I want to share with you guys. It shows the percent changes in the CPI. So all items, this is the number that everyone tracks here in the media, the 8.5% increase. In March, it rose by 1.2%. Much higher than the previous month. So it has been increasing, which of course is not a positive trend. However, the core CPI, which is again the all items less food and energy, is at 6.5% and has decreased over the past few months. Ever since February 2022, it has been decreasing slightly. So I'll have to see if that continues in the months to come. Meanwhile, new vehicles has also been on a downward trend as well. So look at that. Basically last year, we're over 1% gain, but now it's only a 0.2% gain compared to last month. And used cars are actually in the downward trend as well. They actually decreased by 3.8% in March 2022. However, the unadjusted figures over the past 12 months is at 35.3%, even though the decrease by 3.8% in March of 2022. In addition, the food index increased by 1% in March. All 6 major grocery store food group indexes increased in March. In regards to energy, the energy index rose by 32% over the past 12 months, and gasoline rose 48% over the past year, and natural gas rose 21.6%, whereas electricity rose by 11.1%. I'm sure you guys all see gas prices are absolutely insane right now. And personally, my gas bill has been increasing. So it makes sense that natural gas, the index for that at least, rose 21.6%. So the big question, of course, is where does the US go from here? Because inflation is at 8.5%, which is absolutely insane. And I found a really good article on marketwatch.com that I want to share with you guys. So according to Rick Ryder, who's BlackRock Incorporated's Chief Investment Officer of Global Fixed Income, he stated the following: "We are witnessing inflationary conditions that would have seemed like fantasy, or more rightly, a nightmare, merely a few months ago. Indeed, today's CPI report portrayed some very daunting numbers of much higher prices than a year ago, and the report displayed little prospect of a decline in the near term." And here's what others had to say regarding this CPI report here that was just released today. So inflation has probably peaked. So Matt Perron, who's a director of research at Janus Henderson Investors, stated the following: "There's not much to like in today's CPI figures. The best you can say is that the core CPI came in lower than expected at only 6.5% increase on a year-over-year basis." He went on to say the following: "That might give us some relief to markets, which were preparing for the worst. The key now is whether inflation has peaked, and if so, at what pace it will decline. While this reading probably locks in a more aggressive Fed action near term, again, potentially a 50 basis point increase in their May meeting, there is some reason to believe that CPI will decline enough by year end to avoid the most severe Fed action." And the economist at Jefferies stated the following: "While today's report is encouraging, the Fed is a long way from claiming victory and will have to remain in inflation fighting mode." And here's some people that believe that inflation has room to run. So Bill Adams, who's a chief economist of Comerica Bank, stated the following: "The surge in energy prices will ripple across the economy in the coming months and push inflation in other categories of goods and services higher. Food prices in particular are at risk of continued rapid increases because of Russia and Ukraine's role as global grain and fertilizer suppliers." And Mace McCain, who's the president and chief investment officer at Frost Investment Advisors, said the March report shows some moderation in core CPI month over month. However, we expect continued price pressure due to the lockdowns in China as the supply chain struggles to normalize. We're hoping the moderation of core inflation will allow the Fed to eventually pause near the neutral rate at the end of the year and possibly avoid pushing the US into a recession. So comment below with your biggest takeaways from today's video. Also, if you want to see more videos like this rather than housing market updates, then please comment below, and also comment below with any topics you want me to cover on the channel, because I want to try and mix up the channel a little bit here. In any case, if you got any value out of today's video, I greatly appreciate that. Hope you have an awesome day and look forward to seeing you on the next video.